Welcome to Real Vision Crypto. I'm Ash Bennington. Today, I'm joined by Francis Hunt, the crypto sniper. Welcome back, Francis.
Thank you for having me back, Ash. Glad to be here.
It's a pleasure to have you. I should say we're filming here on April 11th. Obviously, quite a lot of price action right now in digital assets. Francis, what's going on?
Oh, yes, indeed. Let's talk about it. One of the key points, actually, as the crypto sniper, we're all macro technical across all markets, Ash. And I think what's happening is that people are coming to realize that there are drivers outside the crypto market, because officially we're in a high inflation environment. This should be Bitcoin honey badger season. Bitcoin should be charging. Everything should be all hunky-dory. But there are macro drivers that are playing a role here. In actual fact, if you're, refer to the share screen, I've just put a couple of bullets in preparation for today's share. And one of the key aspects that I've always noticed that particularly more recently, now that we're a 1.52 trillion, sometimes above 2 trillion market cap, the fact of the matter is that institutional involvement that's been coming in has been treating crypto as an asset class. And many people need to respect that. If they were original crypto guys when it was, a couple of million market cap, 10 million, 100 million, it was a bubble of its own. But as it got bigger and as institutions got involved, more things, macro get involved as well. So I've put a list here on Bitcoin and crypto direction, if you can see here. The dollar stroke DXY direction is very relevant now when you are in a fairly listing market. When you're not in absolute outright Bitcoin dominance bull phase, this starts to hang and have an effect, the grand macro. Also, number two, interest rates and the rate of increase in interest rates, everything to do with monetary policy is starting to come into role, and the market's perception thereof. So recently, at a macro level, whilst not a crypto discussion, you had one of the bigger doves saying on the Fed saying we're actually should be 300 basis points. That's 3% higher in interest rates than we are. That is a super hawkish statement, even though I think that's a gross understatement. It's a super hawkish statement for one of the biggest doves. So what does that mean? They want to drive interest rates higher. So you're having a lot of turmoil in the monetary realm, both around inflation and interest rate policy in response thereto. So this is causing a lot of ructions. And unfortunately, crypto is feeling like that little paper boat in this ocean. Normally the ocean is flat. We're in a bay. But now and then there's a bit of a storm, and it's getting rocked by that, because by market cap size, the debt markets dwarf the total market caps for equity, and the currency markets, of course, are larger still. And there's a lot that's been going on the currency markets. And last time we were with you, we actually highlighted a couple of currency things. We said the euro was going to go down and the yen was going to go down. There was a real tipping and structural problems in the currency markets. How was that going to affect crypto? And we're starting to see a little bit. Also, the correlation. We were one of the first that regularly does Bitcoin versus NASDAQ tech valuations. We will visit that chart again today when we talk about Bitcoin. So the correlation has been pretty tight between the tech direction and Bitcoin. And you've also got to remember, you probably want the composite in there rather than just the mega caps that are cash flow generative. The other points that I talk about is there's a deflation event being built up by the structural breaking. We are the Titanic, and I don't know if you remember the film, but the boat lifts out, and at one point, then the boat actually splits in two. There's too much tension, too much weight. The support for the system is going, and it breaks in half. And in my assessment, we are at that Titanic halvening moment as part of the end of the old, where we're going to be brought into a new financial system. All of this is not crypto specific, but deeply crypto dominating. And a deflationary event, whether it's something that comes out of one of the World Economic Forum's predictions, but we've already had the yield curve inversion, for example. And last time, can I remind, because a lot of people are quite docile, it's one of the best indicators. So let me just pull that point in there. I was just shuffling them as we did. The yield curve inversion is a very dangerous event. It's one of the most reliable fundamentally. And it says you're going to be hit by that deflationary event. Now, the deflationary event could be, we've just had the war, Ukraine, Russia, but that's already baked in. You could have, let's just say, the bank hacking that's allegedly Russia or North Korea or whatever the narrative comes out. What's that going to do to the crypto markets? There's a lot of downside risk. Yield curve inversion, many people say, yes, but that normally takes 17 months to 33 months. I want to remind everybody that the last yield curve inversion on the 10s and 2s was September, October of 2019. We knew already about the pandemic around December, January, and by March we were in a lockdown. That's under 6 months. Unfortunately, the time frame to when lightning strikes, in my opinion, is shortening. The system is more fragile, more sensitive to interest rate swings, more indebted as a result of the pandemic. And as a result, minor moves have big amplificational effects. So that is why I'm in all of current short-term risks are to the downside. And this leads to a system failure, the problem reaction, and that Bretton Woods Mark II moment. On the macro, when you listen to Raoul talk about the great exponential, he's absolutely on the money. And I think his comments there are for the 5-year and the 10-year and beyond. And Cathie Woods, if she survives this system, the metaverse will be coming. But as you'll probably recall, Amazon went up to $106, then crashed to $7, and then went on to multiple thousands, taking stock splits into account. I'm worried about the down leg, how many people we lose in that process, and what you can do in the meantime with regards to that. So let's just deal with number one and go to the charts. The dollar index. This is something we've shown to you guys a couple of times, and we've said the dollar is gaining strength, but it's important to qualify that. It's gaining strength against who it's being measured against in the dollar index. So if I just highlight the currencies that the dollar is typically being measured against, it's these ones: the pound, very strongly the euro, there's a bit of yen. There is, of course, the Swiss franc as well that I've not included. But the dollar is being measured against what I'd refer to as the weaker Western nations that are non-commodity exporters. They typically import commodities, have high relative debt. It's unclear, or they have low gold holdings. Think of Great Britain that sold their 400 tons of gold at the 2,000 Browns bottom. And the euro is yield curve control contemplating, and the Japanese are already doing it. Whilst on the other hand, the currencies that are low relative debt, ironically, the ruble is extremely low. We called the USD ruble for the upside, but you wanted to close that short. Now it's almost an export commodity, and it's got high value in gold. So you've actually got the commodity currencies to these sides. So just looking at the Dixie, you've got to bear in mind, we're talking about dollar strength relative to a lot of weaklings. It's not the most beautiful in the lineup, but in the comparison that it's been drawn against, it is winning that. What we found is as the dollar is being strong, it is lent on Bitcoin when we're not in the major move. The big first cup gold nugget mega break that we had on Bitcoin that ran to its highs was all during the printathon that occurred in dollars from here down on the dollar index. So again, Bitcoin was running from the 10K all the way through to the 64K. Here you go into 20, and then you got May was the other high over here. And you can see this correlates very strongly to the relative lows of the dollar index. And that was a perfect alignment of currency proliferation of the dominant currency of the world and Bitcoin's response as a anti-fiat when fiats were weak. But unfortunately, the corollary has a role in here. And this is what's been happening. We called this inverted head and shoulders, and we said, actually, the dollar index is going to go back up. And a lot of this has got to do with euro weakness and dollar relative strength to that category, as I've already highlighted. And this was your inverted head and shoulder draw. And that's made target now. And many people were shocked to see us being dollar bulls because, of course, the dollar currency is supposed to end. It's inside the context of the dollar index, again, against those specific currencies. Nice little bull flag there, and then a push through the 100 level. And that's invalidated a technical band that we created at the point of all the way across here when we initially reversed down with all the proliferation. So,
Francis, I should ask, we've just crashed through that 100 level here, I think this morning for the first time on April 11th. Does that have a psychological impact when we get into the triple digits on Dixie?
It does. I think it does. But I also think it rests here. And that's part of how markets typically respond. So you've got a bit of a shooting star. You're a little bit low vol, but I think it rests a little here. As I've said, a lot of this is driven by dollar strength and euro land weakness. But I think we churn a little bit before. The bad news is what is on the longer term. I think we see further erosion in the euro. So if I go back and answer this question to the fullest extent, this is our macro draw that we've had. And we've also shown here a couple of times. It's so macro that I'm probably going to have to do a 2-monther. So every candle represents 2 months here. And I'll steal that extra little bit of real estate. I might even have to do 3. This has been a macro falling wedge of this currency against all those others. And what we've done is we've broken it, and we're in a winding up state over here. So amazingly, despite the dollar's weakness, we think you're in a breakout and you'll see 110 plus coming. But what typically happens at psychological levels, like the 100, which is this blue line I've drawn all the way through here, is that you normally you've had quite a surge there. You break it with momentum and you'll have a little bit of a rest period, as per this orange line. And then you go again. During this window, that could bring a little bit of relief to Bitcoin. So I'm going to bring in the Bitcoin chart and try to tie up this narrative, because we've got some interesting crypto charts to show you as well. But it's so important to understand this macro. So hopefully I've answered your question there, Ash. We expect further higher on the long term, but you may rest for now.
Hey there, revolutionaries. Thanks for tuning in. For more content like this, head over to realvision.com/crypto and get unfiltered access to the most brilliant minds in finance and crypto. Join our community of lifelong learners for exclusive access, unparalleled education, and unbiased insights.